Hello, everybody, and welcome to the Nasdaq Dorsey Wright podcast for Monday, March the 22nd. I'm Jay Gragdani, and here joining me this week is Ian Saunders. Ian, great to see you.
Great to see you as well. For first time in a bit, we've been able to actually talk face-to-face on these.
It is. And, this time of year, March 22nd, March, at least in general, evokes a very strong feeling, not only amongst college basketball fans around the country, but even those who don't watch college basketball around the country, as everybody is feverishly filling out brackets for the NCAA basketball tournaments. And while the tournament did not happen last year, it is moving forward this year. It has gone off, at least so far. We're in the midst of the second round. Little differences, and we can chat about that. But it's also one of those times that it reminds us so much that what we can learn from investing or about investing from sports, in particular the NCAA March Madness tournament. And we'll dig into a little bit about that more in a minute. And, it's this time of year, typically in Richmond, Virginia, where the weather's starting to turn. We both, Ian and I, have short sleeve shirts on today, polo shirts on. And so it is getting into 60 degrees. So the weather certainly is turning. And typically last year, the biggest difference with the tournament, I shouldn't say the biggest difference. There's a lot of differences with the tournament this year with the new COVID protocols. But one of the biggest changes, perhaps more subtle change to many, is that the games normally would start on a Thursday, didn't start until Friday. And so normally, historically, in the Richmond, Virginia office would be the day that we would order a bunch of wings from a local restaurant that has some of the best wings in town. We would order some wings, put them around the table as everybody's trying to finish their brackets before the noon tip-off or 12:15 tip-off. That certainly didn't happen this year, but it didn't stop us from getting our brackets filled out.
Absolutely not. Although I think the feverishly filling out the bracket was still definitely an occurrence for me, as I was waiting right up until the end. To not much chagrin, didn't seem to help out all that much this year with all these upsets that we've seen.
There have been quite a few upsets, and unfortunately, the world of Virginia basketball. Virginia, the entire state of Virginia, not just University of Virginia, but the entire state of Virginia had a rough go of the tournament. VCU having to default, Virginia Commonwealth University, that is, having to default, UVA getting knocked out, as well as the other Virginia schools. But nonetheless, there's lots of different ways, lots of different methodologies that people filling out brackets will go through. We did a neighborhood bracket here with my local neighborhood, and all the kids participated. And so it's always fun to kind of watch and see how they select teams, some based on the name, some based on the ranking or the seedings, some based on seemingly, I don't know what, some looking at some of the selection methodologies. Nonetheless, I think it's interesting. And as we kind of dig into the markets and tying back this time, that's certainly something that I think we all can appreciate, and very timely tournament happening when it's supposed to happen in the same season that it normally does too. It's just remarkable, and the lift and the effort that it's taken for everybody involved to actually make all this happen has been just phenomenal to watch it on the surface, and probably have no sense of it in detail of what's having to go on underneath the surface. Nonetheless, one of the big aspects of the tournament is what's called Selection Sunday, which is the day that all of the teams get ranked, and each team is seeded based on their performance over the course of the season. So how they've performed on the court over the course of the season is ultimately what is determining how highly ranked any team is. And so there's 4 different regions, and 1 through 16 being the seeds, 1 being the strongest. And, much like other sports, and much like the way that we look at investing, especially through relative strength, momentum, trend following, is we want to own stocks. We want to own areas of the market that have displayed the ability to outperform the other areas in the universe over time. And we want to consistently be pushing the portfolio towards strength and at the same time, consistently weeding out those weaker areas of the market. And so if we think about that in the scope of a sport, and in this case, we'll just stick with college basketball. Ian, historically, there's been a very, very strong correlation towards teams that have the higher seeds, so the stronger teams, compared to those with lower seeds historically as we've gone through the tournament.
Absolutely. I mean, so if we have a study that we publish each year, that coming out right before the tournament kicks off, looking at the win-loss record round by round of teams in different seedings, right? And so simply looking all the way back from 1985 through 2019 with the pandemic, taking last year's data out of the equation because there wasn't any data there. But say 1985 through 2019, just taking a look at the win-loss records from seeds 1 through 16, and on a round-by-round basis, and looking at that, if you aggregate the number of wins from kind of each seed and then assign a winning percentage to each seed from each of those years combined, you're looking at a number one seed winning percentage in games that they actually play in the tournament. So obviously, if they get canceled out or knocked out in the first round, then that's it for them that year. But in looking at games that they're actually played, they win almost 80% of the time. So just under 80, 79.9% of the time. And we still see the number two seeds win over 70% of the time at 71%. In looking at the top three, so those higher seeded teams, those teams that have maybe more momentum coming into the tournament than others, more relative strength, should we say, have a winning percentage of about 73% if they're in ranks, if they're in seeds 1 through 3 coming into the tournament. So while everyone loves the upset, everyone likes to cheer for the underdog. I mean, at the end of the day, we do see those teams with the higher seeds, those teams with more momentum coming in, generally tend to win more so than everyone's favorite Cinderella story.
That's right, and that always is the big thought, at least an initial thought that many people have when beginning to fill out the brackets is, okay, where am I going to find my upset? Who are going to be the upsets? And there's a lot of time spent on finding out which 12 seed is going to be the 5 seed, which is always a thing that happens quite often in the tournament is in that particular bracket. But the reality is, at the end of the day, the bulk of the winning comes from those higher seeded teams. Like you mentioned, there's always going to be upsets. That's going to happen. That's part of the madness that is March in terms of the tournament. And that is the case in investing too. And when we think about relative strength, there's a lot of academic work out there that we've done, that a lot of other people have done, that have just very simply shown, if you buy the high momentum stocks over time and be disciplined about that, those are the stocks that have shown the ability and potential to outperform over time. That doesn't mean that's going to happen every single day, every single week, every single month. There's absolutely going to be scenarios where a stock that might be considered a weak name from a relative strength perspective will all of a sudden come in and outperform the rest of the stocks over the course of a day or a week or a month. And that happens. If that persists, that's what's important to us. If we see that trend and outperformance persist to the point we might see a stock move up in its relative strength ranking, then that's where we're going to look to identify those areas. And so when we think about relative strength investing, it's really, for us, it's not about buying stuff at the absolute bottom. So it's not about trying to pick the number 16 seed that might win a game in the NCAA tournament, nor is it ever about selling a position or selling a stock that is at its absolute peak. By definition, there has to be a period of outperformance off the bottom before a stock would move into a high relative strength or high momentum category. Similarly, in order for a stock to fall in its relative strength rankings down to what would be maybe considered a weak name, there has to be a period of underperformance off the top. But really, if we can capture the meat of the move in the middle there and be on the right side of the big trends in performance, that's really what it's all about for us. And these trends can last for many, many years. Some things you might see some, as we mentioned, some short periods of underperformance, i.e., an upset from a low-ranked team. But time and time again, there's studies out there that just continue to show that we're far better off just simply buying the stocks with the best relative strength and best momentum, because those are the stocks that have shown the ability to outperform the others. And what I mean by that, it's very similar to sports. We're talking about college basketball specifically, but you can apply this idea to sports across the globe. It doesn't matter if we're talking about baseball, basketball, rugby, cricket, whatever the sport might be. In order to become a highly ranked team or highly ranked athlete, in the case of maybe golf, you have to show the ability to win games, right? You have to show the ability to perform on the field. And that's really when we talk about relative strength and momentum, because we're evaluating the price action of that security. It's all about how has it performed, not what kind of potential does it have, but how is it actually performed on the field of play, being in this case the stock market. And that's a really big important idea. An important concept when we're thinking about relative strength is we're evaluating the price action of that security over time versus all of the other securities in the very same way that a sports ranking identifies the actual performance of that athlete or that team on the field of play over time to see which areas of the market are stronger versus which areas of the market are weaker. So, I think that's a very important point, to keep in mind, as we move forward through not only this market, but through markets in general. And, one of the big trends that we have seen really over the course of the past number of years now is just the strength in general across the U.S. equity market.
Absolutely, Jay. I mean, and in looking at the U.S. equity market compared to other asset classes, I mean, the main ranking that we use on the platform is the DALI ranking, right? It stands for Dynamic Asset Level Investing, and it's a ranking of the 6 broad asset classes initially. So you have domestic equities, international equities, commodities, fixed income, cash, and currencies, all stacked up one against one another, really in underlying in what we call a relative strength matrix. So a matrix is simply a way for us to take each of the asset classes and have them play games against one another, and then just see which asset class wins the most amount of games, right? And so in looking at the DALI asset class ranking, I mean, like you said, the domestic equities asset classes has been the winner of the most games for most of the past, should we say 12 years or so here. And looking at the 2010s decade specifically, it was the number 1 ranked asset class among those 6 areas for just under 90% and 89% of the days there counted in that 10-year period. Haven't seen quite as much data in the current decade. Obviously, the domestic equities asset class wasn't ranked number 1 for the entirety of last year, fell out of favor there. And with the pullback that we got in March, returned to favor there in August, but is now back to the number 1 position. So sitting there in number 1, far and away of international equities, which is in the 2nd ranked position. But we are seeing a little bit of a battle play out there between the 2nd and 3rd international equities and commodities, which will be an interesting place to monitor here as we move through the year. But Jay, I think that point that you touched on there, that it's looking at not just necessarily one particular day or one particular movement in the market. It's important to keep in mind that we're looking for consistency of wins, right? We're looking for an asset class or a sector to win on a consistent basis, because those areas of consistency are the places that you want to be in, right? I mean, I think it's really easy, especially with the news networks as they are now, to get bogged down in the day-to-day movement of things. But taking a bigger step back and looking for that consistency, I think, is something that can be pretty beneficial.
Yeah, it's absolutely right. I mean, and you think about it, going back to college basketball for a second. I mean, one of the things that kind of sticks out to me, and over the past number of years, what Gonzaga this year is the number 1 overall seed in the entire tournament. It wasn't that long ago that Gonzaga was just one of those other mid-majors that got into the tournament, and they were the ones on the outside, so to speak, looking in. They were the underdogs in the tournament, and so they were the ones that were upsetting some of the higher ranked teams early on, and that trend continued. They consistently were able to perform, and that consistency in performance over the past few years now, number of years now, has put Gonzaga where it is, and now it's a number one overall seed. And so along the way, you've seen that trend and that consistency and outperformance just continue to shine through across the markets. And you mentioned that in the equity markets, certainly, generally speaking, equity markets have been ranked number one. U.S. equity markets have been dominant really for going on well over a decade. But that's not necessarily always the case. The market obviously has an upward bias over time. The past 12 years or so have been a generally upward biased market. There's been corrections, pullbacks along the way where we've seen U.S. equities fall out of favor for, like you said, about 6 months last year, move back into number one spot in August. But if you go back to the previous decade, and you go back to the decade from the end of 99 to the end of 09, that was a decade that was encompassed and ultimately dubbed the lost decade for investors, because the S&P 500 produced a negative return over that 10-year time period, despite seeing 4 different 20% movements in the market. 2 of those were up and 2 of those were down. But at the end of the day, investors that just bought and held the S&P 500 got off of that roller coaster, basically the exact same place that they got on, while there was a tremendous amount of leadership coming out of international equities, in particular emerging markets during that decade, as well as commodities. So those areas are certainly can provide very strong performance and robust performance profiles over time. And that's why it's so important to use something like a relative strength ranking process, not only for individual stocks, but to identify leadership trends across asset classes. Because, if we do get into a quote unquote similar time period to the lost decade, there's going to be a lot of value in some of those other areas like international equities and commodities specifically. But with that said, here we are, staring at U.S. equities being the number one seed in our tournament, so to speak. But it doesn't necessarily mean that there's not rotation happening underneath the surface. And we've seen a lot of things changing underneath the surface. We've seen a lot of the rankings getting shaken up, if you will, over the past number of months in terms of where the leadership trends specifically within the U.S. equity market live.
Absolutely. I mean, continuing with the seeding analogy, right? I mean, technology would have been pretty much the number one overall seed from the domestic equity sector's perspective for most of the past 4 years. I mean, and looking at that, technology really been the place to be, leading many of our momentum indices and calculations underneath the hood. Many of our models saw overweight exposure towards technology, and we're beginning to see that transition, or have seen that transition move down out of favor of technologies pretty substantially. The sector is still in the top half of our sector rankings in the Dolly tool, but it's fallen to its lowest tally signal count, so its lowest amount of wins, if you will, since September 2016. Whereas other areas like energy, like financials, have shown a bit more recent improvement. Consumer cyclicals, so it's been a bit more consistent. Those areas making up the top 3 spots in the Dolly rankings have definitely shown more significant improvement, more relative improvement over technology. So not to say that necessarily that means dumping out of technologies is the route to go now, but certainly an area that if there's weaker names in the portfolios, right? You don't want to continue to hold on to teams with a losing record. And so those weaker areas, there's lower attribute names in the portfolio should definitely be a place to keep an eye on. Whereas those areas with maybe more momentum, like the energy, the consumer cyclicals, financials places could be an area to maybe pull some bench players to your roster here moving forward.
Yeah, you're right. I mean, technology has certainly been one of those areas that had just been a dominant force for a number of years, and certainly showing some signs of potential weakness coming out of there. And that's why it's important to monitor some of these trends. And it's not just a sector perspective. I mean, you think about small cap over large cap, that trend. I mean, the past number of years, it's really been the large cap technology names that have dominated, and that dynamic has changed to favoring small caps now. Similarly, on the growth and value side, value has come back into favor in a big way. And that's one of those trends that, the growth over value trend lasted for way longer than anybody would expect something like that to last. And it got at one point in 2020, it was the biggest spread that we've seen in terms of performance between growth and value on a rolling basis, that has contracted back to the point now value outperforming growth. And so for the first time in a number of years, that dynamic has been shifted on its head. So there's, I think that's a long way of saying there's a lot that's changing right now, but we have to continue to go with those leadership trends. So making changes to the portfolios as those leadership trends are changing is certainly the right thing to do right now. Similarly, in terms of the, going back to college basketball, if you start to see teams they're losing games, they're underperforming, their seeds are not going to get as high, and that's because of their performance on the field. Very similar to what we look at with respect to the equity market and frankly, the financial markets, whether we're talking about U.S. equities or international equities, commodities, or even bonds. I mean, bonds, obviously, we could spend a whole podcast talking about what's going on with interest rates now and how that's impacted the bond market. But the reality is, we saw, to your Dolly point, fixed income fell down to number 4 back at the end of last year. And all we've seen since then is interest rates continue to push up, the 10-year rates and all those interest rates pushing up, which are negatively impacting the price of bonds right now. So, that's why it's so important to just continue to monitor those positions, stay on top of where we see those leadership trends in the market.
Absolutely.
And so with that, as always, Ian, appreciate you joining us on the podcast. Appreciate everybody listening to what we have to say in our discussion around somewhat fun, certainly something that we think is a fun topic, that being sports in general, in particular college basketball. Despite how our brackets might be looking right now, it's still a fun exercise to talk about because I think there are a lot of lessons, a lot of analogies that can be drawn between investing in the equity markets and in sports rankings in general, and in particular college basketball as it relates to that analogy. So with that, as always, we appreciate you joining us for this podcast. I hope you like the new format. If love to hear feedback on it, if there's something that you'd like to see, or if there's particular topics that you would like to hear us discuss, please don't hesitate. Reach out to us. Let us know. You can reach us by phone at 804-320-8511. You can reach us via email at dwa@dorseywright.com. So thank you again, everybody, and look forward to talking to you next week.